Hello, and a very good day to you all. I am Eugene, and I'll be the moderator for today's investor call. Joining me on this call will be our three panelists, Praveen Japwani, CEO of UTI International, Vetri Subramaniam, Chief Investment Officer at UTI Asset Management Company, and Ajay Tyagi, Head of Equities, also from UTI AMC. We will start with an introduction and welcome note by Praveen, followed by a macro update by Vetri, and a walkthrough of the UTI India Dynamic Equity Fund with Ajay. Lastly, we will run off the session with some Q&A. Praveen is the CEO of UTI International and is responsible for UTI's business outside of India. He has 30 years of experience in the financial services industry. Without further ado, over to you, Praveen.
Good morning, good afternoon, everyone. Thank you very much for joining us on this India update call. As always, I'll make some opening remarks and then invite our CIO, Vetri, to share his perspective on India macro and the markets, followed by Ajay, who's our head of equities and also the portfolio manager for the Dynamic Equity Fund. There's never a dull moment in our professional lives. The world we live in, between Bloomberg and Wall Street Journal, it seems to roll from one crisis to the next, and almost everything is breaking news, which unfortunately keeps our attention firmly rooted to the short term. It is unfortunate because prudent investing is really about generating alpha from long-term drivers. We are only about 5 months into the year 2023. The Ukraine invasion shows no sign of stopping. We've had Germany in recession, UK on the verge of recession. We had earlier a China recovery excitement, then a China recovery disappointment, and recently the US debt ceiling drama, and also the NVIDIA stock zooming. It is all so addictive. We're held hostage by this daily excitement we get on Bloomberg and the like. And the media commentary is geared towards finding the next new shiny toy. This constant hunt to identify the next new shiny toy is not a dependable or repeatable investment thesis. And predicting what new shiny toy will be is same as gambling. You can get lucky a few times, but you can never get it right consistently. Even Cathie Wood of ARK missed out on the NVIDIA stock rally. In fact, if you look at the S&P 500, it's up about 10% for this year. And as all of you know, the only reason the S&P is up this year is because of the top 6 stocks. If you remove the top 6 tech stocks, the rest of 494 stocks are having a pretty bad year. In fact, the median performance of S&P 500 year to date is negative. And the main reason is poor earnings in the core sectors of the economy. In this global context of declining growth, India is showing robust consumer demand and earnings growth. In short, it is displaying animal spirits. Animal spirits was a wonderful phrase coined by the economist John Maynard Keynes to describe consumer confidence. When people are fundamentally optimistic about their future, they will spend, they will consume. And then this is what underscores the India growth story. And India's GDP growth over the last 30 years has been 6.5% on average, which is really a remarkable achievement, but it has not captured global attention until now. And one of the reasons it hasn't captured global attention all this while is because the world has been growing as well. And when the West faltered, like after the 2008 crisis, China stepped in to pick up the slack. However, now, with even China stumbling, India becomes extremely relevant as a global investment destination. With that backdrop, I'd like to now invite my good friend and colleague, Vetri Subramaniam, our Chief Investment Officer, to throw some more light on the India macro story.
Yeah, good morning, good afternoon, wherever you are, and thanks for joining us on this call today. Thanks, Praveen. There's always something interesting going on in the markets, and that's, I think, a reason that keeps us most occupied in terms of tracking those developments there. But that isn't always the reason to sort of invest. That isn't always a reason to act. But certainly, it gives us a lot of conversation topics, and that's why the stuff that you described, whether it be the debt crisis or whether it be AI and the new hot chip, all of this always keeps us very, very excited. But let's quickly dive into some of the stuff that we are planning to cover with you today. So what we thought we'd do slightly differently this time, and Ravi and Akash and our team have put this section together, which is sort of giving you a snapshot of where does India stand relative to some of the emerging markets, both when we sort of look slightly deep as well as stand back and look at the data. So we'll kick off with this section. So the first really looks at India versus EMs in terms of real GDP growth, looking at it over a very, very long-term period of 10 years and 15 years. And I think those of you who are on this call know this statistic reasonably well. India has been one of the faster growing EMs. The only EM economy which has done better than India over a 10-year or 15-year period has been China. But I would just point you to that last column, which is the expectation from FY22 to 27, which is that India's GDP growth will likely be the best within this entire EM pack over the next 5 years, and certainly also be ahead of China's growth. So I think that's sort of the big reason to think about why India and how India really shines in an EM context. If we just jump from this slide to the next one, and this is a slide on inflation. And when I started my career in investing in India in the early 1990s, if the consumer price inflation was not in double digits, it was something to really celebrate. You see some signs of that in the data here when you look at India's average CPI, 10-year average of 5.36, 15-year average of 7%, and then look how over the next 5 years it's expected to be much lower, sub 5%. One of the reasons for this is that going back to 2016, the central bank, along with the government of India, committed to a treaty whereby they agreed to a policy of flexible inflation targeting. So that's been an ongoing process in India over the last 7 years, with CPI targeted at 4%, plus or minus 2%. And I think except for last year where they missed the target for 3 quarters in a row, we've managed to keep inflation within that level. And I think it indicates a reset of expectations in India about the likely rates of inflation. And very crucially, we now see, by way of this agreement, both Government of India and Central Bank on the same page. And we've actually seen coordinated policy action over the last 4 or 5 years, with both parties trying to make sure that they're helping each other achieve those inflation goals. So inflation in India, yes, higher than perhaps what it's been in other EMs, but I think trajectory-wise, very clearly in sort of declining trajectory at this point of time. If you just jump on from inflation to the next slide, this, of course, just converting it into per capita GDP growth, and you can see the numbers over here in terms of per capita GDP growth. Again, this sort of shows the same picture that we'd already referred to earlier. So I'll just jump on from this to the next slide. I think people have always worried about India's vulnerability. And this was a topic of some of the conversations we've had in the last 12 months, particularly as the US Federal Reserve has, hiked rates in a manner that we've perhaps never seen before at all. And typically, this is a period where people are worried about India's fragility. Those of you who've been in the markets for long would remember India is one of the fragile 5 going back to 2013. But the good news is that this time around, India's positioning has been quite good. On the left-hand side, we have India's import cover in terms of the months of foreign exchange reserves. So our current reserves are about 580 odd billion. I think only 4 countries in the world currently with foreign exchange reserves above the 500 billion mark. India is one of them. And in terms of the number of months of import covered that we have, it's about 10 months, which again places us quite comfortably relative to other parts of the EM ecosystem. On the right side of this chart, you also see India's short-term external debt relative to foreign exchange reserves. And here you can see India's conservativeness. India has never been very keen to borrow in the external markets. In fact, the sovereign does not borrow overseas at all. We do have some quasi-sovereign borrowings, but no direct issuances by the sovereign in the dollar bond markets and so on and so forth. And therefore, this is reflected in a very conservative positioning when it comes to short-term external debt relative to foreign exchange reserves, where India's positioning is much lighter than many of the other EM economies. So I think these two factors, have this time ensured that even though the currency has been under pressure, but then again, all currencies have been under pressure thanks to dollar strength in the last 1 year, but there's been no sign of macro stability concerns. There's been no worries about fragility, and that largely comes back to this data, which shows India in reasonably good shape. So we'll just move on to the next slide. What about leverage? Those of you who've been India watchers for a very long time would certainly remember the large increase that happened in corporate leverage during the previous boom in India, which started somewhere late in the first decade of the 2000s and then sort of stalled early in the second decade of the 2000s. And this was a time where corporate leverage went up very dramatically. But as you can see over here, we've now been in a steady decline in terms of corporate leverage over the last decade or so. So from a peak of about 77% of GDP in corporate leverage, that number has now come down to 52.2%, showing a very steady decline. And in fact, while we don't have the chart here today, some of you might recollect we've shown this chart before. If you look at the bank net NPAs, and you look at corporate net debt to EBITDA and look at this data point over a 20-year period, on both these parameters, India's current metrics are closer to the best numbers we've seen somewhere in the early 2000s. So, India's leverage situation as well as the sovereign situation are much, much more comfortable. So moving on from this to the next slide. This is obviously a question where even when I've traveled across the world and met many of you, has always come up, right? Which is, why does India trade at a relative premium? But the reality is that this premium has held now for a very long period of time, pretty much the last 20 years than I can recollect. India has always tended to be at a premium to the rest of the world. No doubt, sometime in 21-22, this premium really spiked, partly because India was holding up reasonably well, and the big part of the EM index, which is China, was actually selling off. So we saw the premium go to a record level of 100%. After that, it pulled back to sort of the more historical average region of about 50 to 60% premium to the EM index, which is what you see in that gray sort of mountains and valleys that you see on the left hand side. Currently, we are closer to about 70%, so slightly above that long-term average number. But I think the reason for this is also very simply the fact that when you look at return on equity in India and you look at earnings growth in India, then the Indian numbers have tended to stand out relative to other parts of the world. And I think that's sort of been one of the reasons why this premium has sort of sustained relative to other parts of the world and not necessarily impacted the returns over that period, particularly when you look at a much longer track record. So jumping on from this section on relative valuation, just to stand back and, rather than think about valuation just in the context of PE multiples, let's think about it in the context of how does India punch in terms of its weight when it comes to world GDP and also when it comes to world market cap. So what we've got on this chart is India's contribution to world GDP and India's contribution to world market cap, the blue line being the contribution to world GDP. And as you can see, that's got a reasonably consistent upward trajectory. But, markets are obviously far more volatile than economies are. And therefore, you see that red line, which is India's contribution to world market cap, which is a lot lot more volatile in terms of its swings. But point being that through all that volatility, we've broadly sort of tracked our contribution to world GDP. So while we can continue to crunch those numbers in terms of looking at price to earnings, looking at ROE, earnings growth, and trying to put together that equation of is India overvalued or undervalued, I think it's a very simple way of understanding that India's contribution to world GDP and India's share of world market cap have tended to be aligned. No doubt, good asset allocators could use some of the volatility in that red line to move their allocations. But broadly, I would say we've moved in sync. We don't see a major disconnect between these two trend lines. So moving on, this is sort of a longer term trend of what equity market returns have been over the last 1 year, 5 years, 10 years, 20 years. As I said, we've had an Indian market which has typically traded at a premium relative to other EMs, but just look at those numbers over 5 years, 10 years, 20 years, it hasn't really hampered performance for some of those reasons that I mentioned before. And also what I showed you in the previous slide, which is think about it in terms of our contribution to world market cap and GDP. Those two have remained largely aligned with, of course, some level of volatility. Having said that, I'd also point you to the last but one column on the right-hand side over here, which is risk-adjusted returns. And I think, India's equation in terms of the returns and the volatility is generated. The number that we are using here is the 10-year numbers for both returns and volatility. Risk-adjusted returns in India have been quite attractive for asset allocators, investing that too in a single country. And we often have this debate about, should we invest separately in India? Should we do it through a regional vehicle or a global vehicle? And I think, this sort of metric just gives substance to the argument that one should look at investing in India as a, independent thing and not just as part of a larger whole, whether it be EM or global markets. So we'll just jump now to the next slide. I think, one of the questions that I got, particularly when I was traveling late last year and meeting some of you in Europe, and I think Ajay has done quite a bit of that as well, was this whole argument about, India versus China. And I think this was a very strong argument because, particularly in the back end of 2022, there was a lot of excitement about China. Zero COVID is now behind us. They're off to the races. And the Chinese market certainly was off to the races at that point of time. But what you can see here is the performance of India, which is the blue line, the Chinese market, and then also the EM market, which is the green line. And what you can see over here is that while China was certainly very fast off the block in the fourth quarter of last year, and even in the early part of this year, the markets have actually now sort of crossed over. We've not done anything great if you ask me about the Indian market year to date, but point essentially being that, I think some of that catch-up trade in China perhaps now behind us, and market performance not looking as sharply divergent as it did in the last quarter and early in the first quarter of 2023. So we'll just move on to the next slide. Next few slides, I'm just going to quickly cover some of the data that we are seeing in terms of earnings and valuations in India. So we leave behind those comparisons that we were making to emerging markets. So this is the trend line in earnings consensus, Bloomberg consensus data, historical years as well as the current financial year, which is FY24, which is the blue line that you see on the right-hand extreme with the number 983 marked next to it. So that's the consensus expectation for Nifty 50 EPS in 2024. Interestingly, the darker line below that, the sort of black line, which is the FY23 estimate, I must admit that line has been continuously trending lower over the last 6 months. And in fact, we've halted that line at April, but if you actually look at the results as they have come out over the last 60 days, that number has actually dropped further to slightly less than 800. So I do think there is a little bit of risk which is visible in this chart, that actual earnings expectations for actual earnings outcomes for FY23 FY23 have been slightly softer than what was the expectation 6 months ago. And therefore, the implied growth in FY24, which is the year ended March 24, are actually a very high bar. It's almost about an 18% earnings growth expectation. I do think that is a little bit of a high bar. And I think, we could have challenges in terms of actually delivering on those numbers. Though I'd say the 2-year trajectory in terms of a reasonable double-digit earnings growth still looks reasonable. That's what the analysts estimate. But maybe the bar for 24 itself a little bit high given the current global context. Jumping on from that to the next slide, which shows you the valuations. This is, of course, the valuations for the Nifty 500. So this is a 500 stock index. It covers large cap stocks, mid cap and small cap stocks. And you can see over here the sort of record valuations that we saw in India sometime in late 21. The market's done nothing now for almost about 18 months. Earnings are, of course, up almost about 40% during this period. So effectively, the market going nowhere and earnings going up 40%, the market has started to derate. In fact, I'd say it spent a lot of its recent time in that blue zone, which is plus or minus 1 standard deviation of the long-term average. There's been a small rally in India in the last month or so that sort of pulled the valuation up to the top end of that blue band. But I'd say we're still somewhere within that fair value zone, and we define fair value as somewhere as long-term average plus or minus 1 standard deviation. So that's sort of a picture of where Indian valuations are on a 1-year basis. Just jumping forward, this sort of a summary of some of our current thoughts. I think on a global context, one of the biggest dichotomies that we see is that the US bond market is pricing in nearly 80 basis points of rate cuts by December 23, but increasingly the commentary appears to be that we may even get a rate hike in the US going into June, and therefore I think this is one dichotomy that could create volatility in the market. The Fed is not indicating any intention to pivot, in that the bond market believes that is true, and that could be a source of volatility. Without doubt, commodity prices, shipping freight rates, all those indicators which were spiking through 21 and 22 after the Russia-Ukraine conflict, everything is now in retreat. I'd say the bulk of commodity prices, shipping freight rates, container freight rates, all back to pre-Russia-Ukraine conflict levels, some even sinking back to where they were in the middle of 21, indicating a much lower and weak global growth outlook. In India, the Monetary Policy Committee halted its year-long rate cycle. They've effectively hiked rates by over 330 basis points over the last 15 or 16 months. Though they've been withdrawing accommodation for much longer than that, they actually started withdrawing accommodation in October of 21. They're still talking about a policy stance which is restrictive because they've described it as withdrawal of accommodation. But if you look at the liquidity, the interbank liquidity, which is what they also look at in terms of the description of whether the policy is trying to withdraw liquidity or add liquidity to the markets, it's now more or less neutral. And therefore, it does seem like they are now more in pause mode as they evaluate incoming data. I mentioned this point earlier. Profits have come in a little bit softer in the fourth quarter. Profits up about 10% year on year, which is slightly slower than what was anticipated. So we do think there is some risk to earnings estimates in 24. The global economy is weak. Monetary policy settings across the world are still sort of restraining. The fiscal constraint in India, which is a good thing, is that we are continuing to sort of target a lower fiscal deficit, which will also have, in a sense, a sort of restraining impact on growth. Valuations are in the comfort zone, above the long-term average, but in the comfort zone. So we think this is a sort of valuation context in India, which appears reasonably favorable to long-term investors. But there's no sort of desperation to get it there and buy. The markets are not cheap, they're more in fair value. So really what we've been allocating to investors is to stagger their investments over time. Domestic bonds were very favorably placed vis-a-vis equities, I'd say about 3 months ago, but there's been a little bit of a bond market rally in India. So the needle is still slightly pointing towards bonds versus equities. If I look at historical valuations, that's more of a tactical indicator, but not as attractive as the bonds appear to be. The long-term bonds appeared to be, let's say in February, March of 2023. So that's sort of a summary of some of the key thoughts that we wanted to share with you today. I'm going to stop here and hand over to Ajay, and he'll take over in terms of talking to you about the dynamic equity fund.
Yeah, thank you, Vetri, and good morning and good afternoon, everyone. Let me start by very quickly again summarizing our thought process around our strategy of running the UTI India Dynamic Equity Fund. Like we've always said, for us, what's important is looking through the noise, looking through the excitement that Praveen spoke about, and focusing only and only on the economic value creation that businesses have to offer. The markets will always be excited about something. They were extremely negative about anything which was non-ESG compliant, whether it is the defense sector, whether it is the energy sector, whether it is the commodities sector. But all of that was thrown out of the window in 2022. Around the time the war started, and defense stocks, energy stocks, all of them were the most favored for 2022. Things have actually changed once again in the last 3-4 months. But for us, the reason of not owning any of these sectors was the fact that we did not see a sustainable value creation happening in these businesses through the cycle. And equally today, while the excitement may have died down, our views remain the same. We don't see sustainability of growth. We don't see sustainability of cash flow generation in many of these businesses across the sectors that I just mentioned. And therefore, we have chosen to stay out of them without getting anxious about the rally that happened in calendar 2022. So I think that remains our focus, and that's what is written here on this slide. We would continue to buy businesses that basically have those strong economic characteristics of high ROCs, high cash flow generation, low to no debt. And number two, have basically a sustainable and long growth runway in front of them. Like every time, I'll take 2 examples from our portfolio. Every time we try and ensure that we take a different example, and this time as well, we've taken 2 different examples. But before we go there, let us also see how the sector rotation has happened over the last, I would say, almost 15 years. So, on this chart in front of you, we see the Nifty value versus the Nifty quality index. And I would say this comparison is made on a 1-year return basis. The easiest way to interpret this chart is to focus on the blue shaded areas and the yellow shaded areas, with the blue shaded areas actually representing the time frame when quality was outperforming, and the yellow shaded areas representing the time frame when value was outperforming. And as you can see very clearly, over the last almost 2.5 years now, towards the extreme right, we've had a phase of very solid value outperformance. In fact, if you look at this period in the context of the last 16 years or 17 years, you realize that this has been one of the longest value rally that we have witnessed in a very, very long period of time. And of course, fueled by the fact that many of these sectors like energy, utilities, defense, real estate, state-owned enterprises and state-owned banks in the Indian context, all of them added to the magnitude of the rally as well. Moving on. Very similar to the previous chart is this phenomenon of our portfolio actually seeing a contraction in its valuation over the last couple of years. So here on this chart, if you focus on the bottom chart, you would see that we have tried to chart out the premium that our fund commands over MSCI India. It's only obvious a high quality, high growth strategy, which basically means high ROCs and high earnings growth would obviously trade at a premium to MSCI. So our premium on an average over the last 10 years has been about 50%. There are pockets of time when this premium expands. Equally, there are pockets of time when this premium contracts. We've seen a massive contraction in this premium over the last few years, coming all the way down to, you can say, a decade low. Now, that's true of the portfolio. We thought this time we should also show you some of the key stocks in our portfolio, part of our top 10, and how have they behaved over the last 5 years. And we've chosen 5 years because 5 years includes the first 3 years when multiples were expanding. And this is the time when, interest rates were steady. And in fact, they suddenly came down just around the time the pandemic broke. And then later on, by the end of 2021, the market started building in a rise in interest rates. Obviously, we didn't know how strong the rise in interest rates would be in the initial months and quarters. But as inflation kept remaining sticky and refused to come down, those increase in interest rates just kept going beyond anyone's expectation or imagination. And that obviously led to a massive derating of the price earnings multiple of high growth stocks. So in the subsequent 3 or 4 slides, we will show you a phenomenon that has occurred for high growth companies. All of these companies are part of our portfolio, part of our top 10, with basically the white line representing the price earnings multiple. As you can see here on this slide, for Avenue Supermarts, we've seen an increase in multiples through 2021, but we've equally seen a massive contraction in multiples starting the second half of 2021, bringing them all the way below their long-term average. If you go on to the next one, Ravi, that's Maruti, India's largest auto company. And auto remains a growth sector in India. Maruti is, believe it or not, a business that throws out around 30 to 40% return on invested capital. Yes, it is unheard of in the context of global autos, but because of the strong moats that Maruti has created, the strong distribution network that it has, plus the support of its parent as well as its partner Toyota in terms of R&D, its cash flow generation remains strong, because of which its ROCs remain strong. And Maruti too witnessed a sharp derating. And this derating has brought it down below its long-term average and very close to what it used to be in 2018 and 19. If you move on, a very similar story with Bajaj Finance, one of our top 3 or top 5 holdings consistently over the last 6-7 years. I will talk about Bajaj Finance in the subsequent slide, but the story is the same. One of the fastest growing lenders in India, with very, very strong outcomes in terms of return on assets as well as loan growth. It saw a massive expansion in its price to book value multiple between 2020 and 21, but equally saw a very sharp collapse. And over the last few months, it started to come up, but still below the long-term average and below what it used to be in 2018 and 19. So I think that's the story of most stocks that you would call as quality stocks or growth stocks. And we have always focused on the business outcomes rather than trying to forecast how the markets would react to rising or lowering interest rates, inflation, global macros, and so on, because we know that they are difficult to predict and even more difficult to basically kind of rotate from one sector to another or one stock to the other. So we've always chosen to remain much more patient, track the business outcomes, and remain focused on only the business outcomes, and pull the trigger only when we realize that the core hypothesis that we have for a business is now no more valid, or now is actually getting challenged. Let's move on. I told you that we will talk about 2 different stocks in our portfolio. So this time we've taken Bajaj Finance, one of our top 5 holdings. We've been excited about Bajaj Finance over the last 6-7 years, and I think the story remains as solid today as it was 3 years back or 5 years back. First of all, a top-down view on the Indian banking sector and the Indian credit growth. So the credit situation as of now in India is $1.8 trillion in terms of size. And this market, the credit market, is growing at, give or take, around 13%. Obviously, The more nimble-footed banks and lenders are growing at a rate faster than this, because the situation in India is that the state-owned banks are still commanding somewhere around 60 to 65% of the overall credit. So 65% of this 1.8 trillion is still with the state-owned banks, and they are not as efficient as the private sector banks. Therefore, they are losing market share over the years. And this loss of market share is being picked up by private sector banks and non-banks like Bajaj Finance. Be that as it may, the fact also is that household debt to GDP in India is still very low. It's just 38%. And it's been around this number for a very, very long period of time. So the Indian consumer is not over leveraging herself, while consumption growth is happening in the country, but it is not happening on account of cheap credit or over leverage by Indian households. It's happening on account of higher disposable income. The household debt to GDP still remains a very manageable figure of 38% against an emerging market average of 50%. Now, within this, a player like Bajaj Finance is just having a 1.5% market share. It's their stated goal to reach to a 4 to 5% market share in the medium term. And they do have a very long runway for growth. Some of the larger banks in India are having market shares of between 5 to 10%. The largest bank in India, which is a state-owned bank, has a market share of over 20%. So from 1.5 to 5% is not something which is difficult to achieve. If they continue to execute well over the coming years, they can reach to that kind of number. And they have a diversified portfolio. They're doing multiple things insofar as financing consumption is concerned, whether it's consumer loans, mortgages, also rural and small and medium enterprises loans. And they are always hungry to work at the adjacencies to innovate on new categories, provided the new categories are ROA accretive and they don't come at a massive credit cost. Last but not the least, what has been the success story behind Bajaj Finance? It is their ability to grow their customer franchise, by which I mean recruiting more consumers to whom they can lend. This consumer franchise has increased at the rate of 23%. So they're not been giving loans to the existing set of consumers that are already in their fold. They are actually increasing the number of consumers every year. And this number, which is approximately 70 million as of today, has grown at the rate of 23% over the last 8 years. 8 years because we have data over the last 8 years. Unfortunately, we don't have data over the last 10 or 15 years. And equally, once these consumers come into the fold, they do a lot of cross-selling. And this cross-selling, by the way, has also grown at a very healthy rate of 23%. So I think there are these two twin engines: acquiring more customers and also looking at the existing customers and trying to cross-sell different products to them. Their stated objective is to work with an ROA of 4%, something which is difficult to achieve even for the most efficient banks in India. And while they would have grown at 30% in the past 10 years, they wish to grow at least 25% in the foreseeable future. If you go to the next slide, Ravi, thank you. You see the outcomes in terms of the loan growth. At the top left, loan growth over the last 10 years has grown at 31%. This is the number that they are continuing to target at about 25% in the foreseeable future. Profits have grown at 35% because their ROAs have actually continued to trend up. In fact, the ROAs are now around 4.5% already. And they want to maintain that, but we have only considered a 4% ROA going forward. Last but not the least, something which is extremely important for all lending institutions is the quality of the book. And here again, they have always been surprising positively. Let's look at the chart on the bottom left-hand side. The blue line here is basically the gross non-performing assets for Bajaj Finance over the last 10 years. And you can look at this line. It is, of course, slightly volatile along with the economic cycle. But even during the pandemic, for an institution which basically does a lot of unsecured lending, these gross non-performing assets did not cross 1.8%. And today they have declined to a decade low level. So quality of the book has always been the focus area for Bajaj Finance. And number two objective has been, without compromising the quality of the book, showing industry leading growth. So this story remains still valid for us. The stock of Bajaj Finance, like we showed in the previous charts, has gone through re-ratings and de-ratings, have gone through a difficult period and a good period. But so long as the business outcomes are great, we know that our patience around being a long-term shareholder of this business will actually be very rewarding for us. The next company is a much more smaller company, something we picked up in late 2019. This is a company called IndiaMart Intermesh. This is part of the technology sector. And this company is basically India's largest B2B classifieds company. Like we've always maintained, while we have a very sharp focus on the emerging technology companies in India, but we will never compromise our quality focus. Therefore, we are always looking for companies that have a proven moat, which can help them generate strong cash flows and not be burning cash, and that too burning cash for a continued period of time without profitability in sight. So IndiaMart is one such company which we discovered in 2019. A company which has been in business for more than 15 years, has already established a track record of profits and cash flow generation, has 60% market share. The beauty about this business is the strong network effects that start to emerge after you gain such a high market share. They have 7.5 million registered suppliers, 170 million registered buyers, and 95 million listings. So if you were to type anything, any product here in India, chances are that 9 out of 10 times the Google search will take you to the IndiaMart page. Such has been the very strong network effect. But the good news also is that India today has 13 million GST registered small and medium enterprises. Out of this 13 million, 7.5 million are already there on IndiaMart's website. But only 0.2 million out of the 7.5 million are the paying subscribers. So the idea of IndiaMart is to get everybody onto the website, give them the service free for a few months, let these people realize the value that the site is adding to them, and then start to charge them. And that's been the evolution of this platform, and also the evolution of their strong cash flow generation year after year. If you go to the next slide, we have the strong growth trajectory. As you can see, as I would say early as 2017, they started generating cash flows. And ever since then, they've actually been generating free cash flows consistently, including the period of the pandemic. Their paying subscribers have been growing at a very, very healthy clip of 16%, and their realizations have been growing at about 6%. So this is an example again of a technology business which has scalability well into the future, and is already profitable and is already cash accretive. It went through a horrible time in 2022. The stock was down more than 50% because all technology stocks globally were being massively derated, while it has recouped a lot of those losses. But the fact is that what excites us and continues to excite us is the strong outcomes even through the last 12 or 18 months. Yeah. On to the next one, and this is where again I go back to what Praveen said, that the world and the financial markets are always exciting, but our portfolio remains as boring as it always has been, because we are focused more on the outcomes of the business rather than the narrative all around. So not much has changed between now and exactly 1 year back. Our key sector weightages are pretty much in the same ballpark. Of course, there are always some mark-to-market changes that are happening, but it is never our endeavor to rotate among sectors. It's never our endeavor to try and figure out which are those sectors and companies which the market would actually reward over the next few quarters or would punish. And therefore, you would see very little change, even over a 5-year period, if you were to look at our sectoral breakup. Yeah. Very similar behavior in our top 15 holdings. The big change that may be visible to you is LTI Mindtree showing up at the top, which was at position number 5. And the reason for this is that 2 of our portfolio holdings, which was L&T Infotech at number 5 on the right-hand side, and Mindtree at number 11, again on the right-hand side, got merged. Because of this merger, their combined weightage is now higher than 6%. So it's not a voluntary change that we have made. The change happened because of the scheme of arrangement, but we are only happy about this because the two have merged to become a much more solid combined entity. And, the business lines and especially the verticals that both of these companies were focusing on were very, very complementary. So the overlap was very limited. And as a result, the combined entity has become an extremely strong, formidable player, which will continue to show industry-leading growth. Other than that, no significant changes. Obviously, there will be some mark-to-market changes. Yeah. A couple of entries and a couple of exits, something which is very, very normal for us. We don't churn the portfolio a whole lot. Our portfolio churn is between 10 to 15%, continues to be the case. We are always hunting for new ideas and new businesses which can deliver sustainable long-term growth with consistent cash generation. Equally, we are always evaluating our portfolio holdings to figure out that is the original hypothesis still valid or has it been invalidated? Last year, we saw two of our portfolio holdings, one of which we had held for 7 or 8 years, the other which we had held for about 4 to 5 years, seeing a slowdown in growth, and therefore we decided to actually exit them and allocate that capital to some other businesses. Yeah. Next one, please. Now, important to study this chart because while we don't rotate a whole lot, but at the same time, we are also disciplined investors. We don't just go along with the market in the direction in which the sentiment is moving. In fact, we always try to be as counter-cyclical as possible. So on the top, so by the way, let me first describe this slide to you. This slide is about the top sell trades and the top buy trades for the previous 3 calendar years, 2020, 21, and 22. Let me start with 2020, a year where all technology companies were enjoying the party when their multiples were just going up, as if there is no tomorrow. And InfoEdge, which is one of the stocks that we have held for 10 years, and I call it one of the best internet stories in India of the last decade, also saw a massive re-rating. And at that juncture, we realized that while we love the business, but the valuations are becoming unwarranted. And it was one of our, not one, it was the top sell trade for us for 2020. Equally for 2020, when the same business actually was seeing a very punishing action on terms of its stock price and the valuations came down significantly, to our mind, again unwarranted, but this time in the opposite direction, it became our top buy trade. Because we realized both in 2020 and 2022 that the business remains the same. The growth levers for the business had not significantly changed for the positive in 2020, just like the growth levers and the growth outlook for the same business in 2022 had not deteriorated, but the market mood and sentiment had deteriorated. And we just went out there in a disciplined manner to take advantage of that. And we just went out there trying to actually buy or sell to bring the position size and to the desired level, which in case of InfoEdge is about 3%. So on both time periods, we had the ideal position size for a business like InfoEdge in mind. When the markets were bidding it up, we were pruning exposure back to 3%. When the markets were actually selling down the stock, we were again buying to bring the exposure back to 3%. So that's basically the typical behavior. While we don't rotate the fund, but we also stay very, very disciplined in either direction. Yeah. So the last one is basically on what's hurt us in the last 1 year and what's benefited us. I'll first talk about the green, I would say, shaded areas on the right-hand side. These are the ones that have helped us. And look how quickly things change. Same time last year, IT or information technology was hurting us badly. It has already contributed about 87 basis positively to us over the last 1 year. Same time last year, we were bleeding badly because we were not owning energy stocks, because we were again telling about our longer term hypothesis on energy. It's contributed 1.8% positively to us. The same time last year, utilities and power utilities particularly were doing very well. We were getting hurt because we have zero exposure to them. And, they've been a source of positive attribution. So, markets will keep changing their mood. our core hypothesis always is that track the business, don't track the market mood. Things will always mean revert, but if the business is creating value, it will indeed help you to generate sustainable alpha. So I think that was about the fund over the last 3 months and 1 year. I would now hand it over back to Eugene for Q&A.
Thank you, Vetri and Ajay, for your relevant insights. I will now commence the question and answer segment. We'll kick things off first with 2 questions for Vetri. The first being, what is the team's view on the challenges faced by the local job seekers due to the limited job opportunities, with the strong competition right now?
Sure. Thanks, Eugene. I think we can stop sharing the screen. Do we need the screen right now? Okay. Anyway, so that's an interesting question in terms of the job situation in India. Frequently, when people are polled in India for their satisfaction with the economy, the 2 points where typically satisfaction levels tend to be low, or rather unhappiness tends to be high. One is inflation, and second is employment. So I think this is always been the sort of popular sentiment. But I think my response to this question would be, what's the data saying, right? So the best data we have is an unemployment number published by a Indian statistical economic think tank called CMI, and they have the longest running data set on unemployment. Nothing in that data set suggests something out of the ordinary. Unemployment in their last published monthly number running at about 8%. This is up marginally over the last 1 year, but if I were to look at the numbers that they used to publish prior to the pandemic in 2018, 2019, the number was in that 7 to 8% range. So really, in that sense, I would say it is status quo. But I will make one point over here, and that is the fact that India does have what we would call disguised unemployment, which is to say that people do not have the kind of jobs which would provide them with social security benefits, pension benefits, health benefits, essentially employment in the organized sector. Now, one way of looking at this is if you look at the last year, when India's largest bank, State Bank of India, they run an annual program for recruitment of what they call probationary officers. So these would typically be people who are sort of graduates and postgraduates for officer level jobs in the bank. They wanted to hire 2,000 people and they received 1 million applications. So I think the question has to be sort of nuanced in terms of my answer. The aggregate data in terms of statistics does not indicate any deep pain in terms of unemployment, but there is certainly a continuing problem in India that people are not getting the kind of organized sector roles that they would want, which gives them the benefits that I talked about, and that's reflected in this high level of demand that you see particularly for organized sector roles. But certainly I don't think anything out of the ordinary in the data.
Right. Thanks, Vetri. Moving on. The second question for you would be, the general world economy right now is expected to slow down due to inflation and many other reasons. So how can the Indian economy continue to grow?
Yeah, so Eugene, I think, the way I think about this is, look, the central bank's last GDP forecast for FY24, which is year ended March 24, is about 6.5%. If I look at most professional forecasters on the street, they are closer to about 6%. Exports of goods and services about 25% of GDP. If you think that it's going to be a difficult year on that front, you could, shave off 25 to 30 basis points for overall GDP growth. Reason being that, remember, India is actually a net importer because of crude oil, and therefore, even though we'd get hurt on the export side, simultaneously we'd also get a benefit on the import side. So there's maybe a 25 to 50 basis point impact because of weaker growth outlook, not more than that. But I think the better construct when I think about how to think about Indian GDP is really to go back to the other side of the equation and think about this in terms of savings investment, the incremental capital output ratio, and therefore potential growth. Now, I think the strongest point for India is that overall savings rate remains closer to about 28 to 29%. Household savings rate remains just slightly shy of about 20%. Corporate profitability is extremely strong at this point of time. The investment rate for the last year and this year is running at close to 31 or 32%. So that strong savings converting into investment and ICOR investment capital output ratio, which has run in India at about 4.25, converts into GDP growth potential of about 6.5%. So to anybody who asks the question, what is driving GDP growth in India? I think it comes back to the self-sustaining nature of the equation in terms of savings, investment, and an economy which tends to be more domestically oriented than globally oriented.
Thank you, Vetri. Now, over to you, Ajay. This question posed by a member of our call. After a relatively large outflow of foreign institutional investors in India in 2022, how are the flows currently looking for the first 5 months of 2023?
Sure. We have a slide on this. Now, this is basically the FPI flows into India all the way from 1997. So you can look at this data, which is almost 25 years. The bars which are in the red are the years for the outflows. So 2008, Lehman crisis, 2011 and 12, particularly 2011, the European crisis. 2018 is when the Fed had started to increase rates, stopped somewhere in between. And 2022, again, the year of very sharp increase in interest rates. So yes, these have been the years of negative flows. The good news is that over the last 5 months, we have started to actually see positive flows. I also want to draw your attention to the fact that over the last 25 years, there haven't been years of back-to-back massive outflows. And yes, because of the mood of the market, the sentiment globally, the risk off that happens, from time to time, you could see huge outflows from emerging markets, India included. But unless until the long-term story of India reverses, I really doubt that we would see a sustained outflow of foreign investments from India. So while none of us can say with certainty what would be the direction of flows through 2023, but the history does tell us the fact that so long as India continues to grow and grow profitably, there would be long-term sticky money coming into the country, but there would also be certain episodes which would be termed as risk-off episodes like we saw in 2022. Yeah.
Thanks, Ajay. Sticking with you, I would like to bring up the hottest topic, for the Indian economy in 2023. Has there been any negative development in the Indian market caused by the whole Adani saga?
Sure. I think although the Adani episode is now slowly dying down, but yes, it was certainly a big topic of discussion through February and March. Let's have the facts first. Well, we haven't been positive on the Adani group. We haven't owned any of their companies. And for us, the simple reason has been the over leverage through many of their group companies. But while, there was over leverage because they wanted to really grow very, very fast. But the fact also is that in some of the businesses, they are one of the best executors. Nobody can deny the fact that in some of the businesses they are into, their execution has been par excellence, which also means that many of these businesses and the operating assets that are there in these businesses generate cash flows. So, the big worry factor for the market is what if the Adani group goes belly up? Somewhere in the presentation, we saw that India's overall credit market is 1.8 trillion. The total loans to the Adani group from the Indian banks is just $10 billion, which is basically 0.6%. Even for a minute, if you assume that all the operating assets of Adani stop to function, they can't service debt, even in that hypothetical state, the loss to the Indian banking system is going to be 0.6%. But like I did mention, many of their operating assets are doing very well. The problem is high debt at the group level, and they need to sort this out. Maybe they need to sell certain assets. But the fact is that in either case, it's not a serious debilitating impact on the Indian economy and the Indian banking sector. Yeah.
Thanks, Ajay. Moving back to you, Vetri. There's a lot of excitement with Apple opening its first retail store in India last month. Do you see any other international firms following suit?
Honestly, I'd say it's a bit of a sideshow. I mean, it's good to know that Apple is opening stores in India, but look, their products have been widely available even otherwise. And, when it comes to foreign retailers in India, there are so many single brand retailers who've been in India for a long period of time. You would be aware, perhaps, if we may have discussed this with you in the past. Multi-brand retailing is where India doesn't really allow foreign investment, but single brand retail is something which has always been around. So, I wouldn't really say this is something to get excited about. I don't think it's going to change the retail landscape in India. If Apple is doing it, they're doing it because they recognize the size of the market, the potential, and maybe they're trying to build a domestic market for their product, given that they're now also building so much manufacturing capacity in India. They've talked about moving 20% of their global production to India over the next few years. So I think the bigger story would be India's success in terms of enabling companies like Apple to shift their production out of China and making a home in India for production, rather than this retail sideshow. It was good to see, Mr. Cook in India. He met a lot of celebrities, made all the front pages, but honestly, it's a sideshow.
Thanks, Vetri. I'll be taking some live questions from the floor right now, which were posed. So, any of you can go ahead. But this one is specifically for you, Vetri. With the earnings expectations, at risk, why should India keep its current valuation premium?
As I said earlier, there is certainly some risk to earnings. I'm not going to dispute that for the reasons I said. We can debate about where that premium will be. As I said, you look at that chart, the premium's been, in real crisis situations, it's gone down to, 20-30% premium to the EM basket. But the average has tended to be closer to 50 or 60%. By the way, that's where we were even 2 months ago. And then in the last 1 month, the markets rallied a bit. So, to my mind, there's no point looking at the valuation premium on a daily basis. What you want to look at is when the premium is, 1 standard deviation or higher than long-term average, and when it is 1 standard deviation below. Today, it's somewhere, bouncing around in the middle. So, yeah, I mean, as I said earlier, stagger your investments, but, don't read too much into that number of the premium, because mathematically, it's driven by stronger ROE and earnings growth prospects. And if you just look at a big picture, there is nothing out of sync in terms of India's contribution to global GDP and India's contribution to market cap. So I don't see a red light. It's amber. Drive carefully by all means.
Thanks, Vetri. So note that Bajaj Finance loan growth has slowed down. Maybe Ajay, would you like to clarify what is the company doing to grow its loan growth and NIM margin in the current environment of high interest rates?
Sure. Let's talk about the loan growth. I think this is bound to happen because as you grow larger in size, obviously you cannot continue growing at the 30% kind of growth rate that you were enjoying. And I would say for a lending business, it's very important that you first try and protect the book rather than continuing to focus on growth. So I think it's good news that Bajaj Finance has been saying that for us, growing at 25% is good enough. We're not fixated to 30%, which was the growth of the last decade. But by the way, 25% is a very, very healthy growth rate by all means. As far as NIMs are concerned, I think net interest margins will actually see some impact in a rising interest rate environment, because a lot of the book of Bajaj Finance is wholesale funded. They're not a bank, so they obviously don't have access to current accounts and saving account deposits, but nothing which is materially different from what has happened in the previous cycles over the last 10 years. So not a cause of worry. In fact, ROAs have trended upwards. So yeah, I mean, on both growth and NIMs and ROAs, I would say a situation firmly under control.
Thanks, Ajay. Another question posed from the floor would be, the last 1 year return of the funds have been quite negative. So what kind of return can one expect from the dynamic equity fund and also the balanced fund in the next 3 to 5 years?
That's always a difficult one to answer, because here we are really forecasting about what not only the outcomes in terms of business growth, in terms of profitability and earnings growth, but we also have to forecast the valuations between today and let's say 5 years out. But let me just say that, over a 5-year period, if the valuations of the market remain around where they are today they are maybe 10 to 15% higher than long-term averages. So if they trend down to the long-term average and our earnings growth continues to remain around 14-15%, which has been the case in the past and which is what we are looking forward to in the medium term, which is the next 3 to 5 years, then returns also should be somewhere between 12 to 15%. Now, this is basically a rupee number, by the way. Rupee has actually continued to depreciate against the dollar in the medium to long run between 2 to 3%. So you have to knock that out. So Indian rupee terms, I'm comfortable guiding to a 12 to 14% kind of long-term return. There would be movements from year to year, so difficult to say what the return would be exactly at same point of time, 3 years or 5 years out. But I think more or less it will track our earnings growth. Dollar return, we need to shave out somewhere between 2 to 3% from this number. And yeah, you can do the maths.
Thank you, Ajay. Vetri, this one's for you. What is the view on the Indian rupee for the rest of the year?
I wish I was a good enough soothsayer to tell you what we'll do over the next year. Don't really have a very strong view over there, except to say that, I think we've sort of seen the worst of the rupee in terms of the pressure coming partly from pressures on the current account deficit. Remember, there was a period where we were looking at the current account deficit running at an annualized rate of about almost 3.5 to 3.7%. This was somewhere in the second and third quarter of last year when commodity prices had spiked. However, if we look at the data more recently, the CAD, the current account deficit, is trending back somewhere below 2%, which is pretty much in the comfort zone of the central bank. And remember, when I talked earlier about India's savings rate and the investment rate, that's a 2% gap. That's what is getting funded by the CAD. So I think that's the kind of number where everything starts to fall into sync. We are now closer to a 2% CAD. And B, when I look at it more structurally, India is talking about an inflation target of 4 plus or minus 2%. The US Fed talks about a target of 2%, but I'm increasingly seeing chatter that they may never get back to 2% in a hurry, and therefore they'd be most really happy even if they're at 3%. I'd say then the interest rate differential between these two countries would end up much smaller than the kind of number I was used to when I started my career 30 years ago. And I think Ravi's just pulled up this slide on the screen. If you look at that, this is sort of the 5-year rolling return of the rupee, and you can see that almost about 50% plus 60% of the time, actually the rupee's annualized depreciation of a 5-year rolling period is less than about 2 to 4% per annum. So I would tend to assume that if you were looking at India today, looking to sort of invest for the next 3 to 5 year period, then I would be very comfortable with working with a 2% to 3% annualized depreciation. If India is successful, the central bank governor says 4% target, and the US actually gets stuck at 3%, then you could even get a little bit of a surprise in terms of how the rupee sort of does well relative to the dollar. But my baseline would be somewhere close to 2% per annum being the annualized rate of depreciation relative to the rupee, and that's in line with this sort of histogram and distribution that you're currently seeing on the slide. And remember, this is actually covering a period of 23 years. Inflation targeting and the success that we've had is more of a recent story, only the last 6 to 7 years. So I tend to believe that this data will increasingly move towards the left.
Thank you, Vetri. I have a final question for you, Ajay. 1/4 of the portfolio is invested in the banking and financial sector. Do you foresee any surprises like the ones we have recently seen in US and Europe?
Sure. I think before we go into the specifics, let's have a look at where the Indian economy is in terms of household debt to GDP. So here on this chart, we have India represented in the yellow line, and you can see since 2009. And we have chosen that 2009 because that was the moment of the financial crisis, after which every economy tried to support and perk up demand by increasing leverage. And that's very much visible in, let's say, the blue line, which basically represents China, where the leverage has increased from 20% household debt to GDP all the way to 60%. And in fact, even the emerging market average, which is basically shown in the orange line, which has also moved up significantly. India, on the other hand, has been in the same ballpark. In fact, it's slightly declined over the last 15-year period. So the big picture view is that the Indian consumer is not over leveraged. The Indian household is not over leveraged. Remember, accidents happen when there are instances of over leverage. Here in India, the consumption boom is not being supported by over leverage. The consumption boom is being supported by India's very strong disposable income growth, which is helping consumers actually go out and spend. So with that in mind, we are comfortable having 1/4 of our portfolio in banks. But do remember, for us, it's basically those 3 or 4 banks which have shown very, very strong underwriting capabilities over decades. For us, what's important is demonstration of underwriting over a prolonged period of time. And these banks essentially are retail focused. They are financing India's consumption boom rather than writing large checks for financing infrastructure, for financing capex and so on. So we feel comfortable about the kind of book that these banks have. And to that extent, we don't see a major risk coming out of this part of the portfolio. We remain watchful and vigilant, but as of now, I don't have anything red to report. Yeah.
Thanks, Ajay. With that, we have come to the end of today's session. We'd like to wish you a wonderful rest of your day and look forward to welcoming you again to our next scheduled call. So take care, everyone, and goodbye.
Thank you, everybody, for joining us today. Thank you. Bye-bye.
Bye.